Imagine you aced your final exams, your income just went up by like 16%, and your bank account is, well, it's practically bursting with cash.
Sounds like a pretty good day.
Right. But now imagine waking up the very next day to find out everyone thinks you're a complete disaster and they instantly wipe 10% off your total net worth.
Yeah, that is a very rude awakening.
It really is. And welcome to the paradox of Netflix in April 2026. If you are opening your brokerage app right now and staring at that ticker symbol, NFLX, you are looking at a falling trend throwing off massive sell signals.
Definitely massive.
But underneath that panic, are you actually staring at a strong buy that is, secretly undervalued? That is the billion-dollar question we are tackling today. We are jumping straight into the deep end to unpack this dizzying April 2026 post-earnings plunge.
Yeah, and to really understand what happened here, we have to look past the headlines and examine this totally fascinating stack of fresh data we got.
Right, because there's a lot to go through.
Oh, tons. We are going to analyze their Q1 2026 earnings report from April 16th, the immediate market reactions from April 17th through the 20th, some deep technical analyses, and some seriously intriguing insider order flows.
Which I can't wait to get into.
Same. But before we break all of this down, let's just set the ground rules right. This deep dive is a natural human debate to help you understand a very complex market landscape. It is an educational exploration, not financial advice.
Exactly. And as we navigate this landscape, take a quick second to, hit that like button, subscribe to our YouTube channel, and you absolutely must drop your feedback in the comments. We want to hear your take as we uncover these layers. So let's jump right into the immediate catalyst. Why did this stock just jump off a cliff?
Well, so on April 16th, Netflix reported their earnings. And the very next day, the stock just plummeted 9.72%.
Man, nearly 10% in a day. I'm looking at the summary, and by the close of April 17th, the price settled at $97.31.
Right, which is a dramatic shift in valuation.
Yeah.
I mean, to give you a sense of scale, the 52-week high for this stock was $134.12.
Oh, wow.
Yeah, and the 52-week low was $75.01. So sitting down here in the mid-90s, we are seeing a massive retreat from those recent highs.
Definitely.
And the daily trading range on the 17th was incredibly tight and volatile, bouncing between just $95.10 and $98.74.
See, this is where my head starts to spin, because I am looking at their top-line revenue, and they actually beat expectations.
They did.
Like, they brought in total revenue of $12.25 billion for Q1. That is a 16.2% increase year over year.
Yeah, it's a huge jump.
Right. So beating revenue by jumping 16%, but still losing nearly a tenth of your company's value overnight? I mean, that makes no logical sense on the surface. Okay, let's unpack this. It's like getting an A on your report card, but your parents still ground you because you said next semester's classes look tough.
That is actually the perfect analogy.
Yeah.
Because what's fascinating here is that the disconnect happens because the market is a forward-looking mechanism.
Right. Always looking ahead.
Exactly. The stock market rarely rewards a company for what it just did in the past quarter. It is entirely obsessed with pricing in what it believes the company will do next.
And Netflix just gave them a reason to panic about what's next.
Two massive reasons, actually. First, they offered highly cautious forward guidance. They projected their Q2 earnings per share, or EPS, at only $0.78.
Ouch.
Yeah.
Right, so for a company historically known for aggressive, explosive growth metrics, signaling that profits might slow down next quarter immediately spooks institutional investors.
And then there was the bombshell announcement. Reed Hastings, the co-founder, is departing the board.
Yeah, that was huge. A visionary founder stepping away completely is a major psychological blow to the market. I mean, Hastings navigated this company from mailing DVDs in red envelopes to totally dominating global streaming.
Right. The end of an era.
Totally.
Oh.
So when a leader like that exits, coupled with weak forward guidance, the market doesn't just casually sell off, it stampedes toward the exit.
And I want to talk about that stampede, because the trading volume on April 17th seems, almost unbelievable.
The volume was staggering. On that day, 125.96 million shares traded hands.
Wait, 125 million?
Yeah, and to put that in context, their 10-day average volume leading up to this was just 36.05 million shares.
Wow.
We're talking about nearly 3.5 times the normal trading volume. It's picture a crowded theater where someone yells fire and every single person rushes the exit doors at the exact same moment. That is institutional dumping.
Okay, so if the market is panicking over the future dumping shares by the millions, What does the actual physical foundation of the company look like right now?
Well, that's the thing.
Because the ship is truly sinking, the financials should reflect that, right? But
Mhm.
looking at their overall health, it seems like they are, well, swimming in cash. Can you break down the actual income numbers?
Sure. So the income statement is where things get really nuanced. For Q1, their GAAP net income came in at $1.23 per share. Now, GAAP stands for Generally Accepted Accounting Principles. It is the strictest, most rigorous way a company has to report its earnings because it includes all the ugly expenses like stock-based compensation.
Got it. And what were they supposed to hit?
Wall Street analysts had estimated that number would be $1.34. So yeah, they did miss their earnings estimate for the quarter.
Right.
But if you zoom out to their full fiscal year 2025 numbers, they brought in an annual revenue of $45.18 billion with $10.98 billion in pure net income.
$10 billion in net income.
Exactly. This is a wildly, historically profitable enterprise.
Okay, but sure, net income is one thing. What really caught my eye here is their cash flow. Because, traditional media companies usually burn massive amounts of cash just to produce new shows, hoping they pay off years down the
I'm
line.
constantly burning cash.
Right, but Netflix reported free cash flow for Q1 at $5.09 billion. That is a 41.6% margin. And for the full year 2025, they had $9.46 billion in free cash.
And that free cash flow metric is arguably the most vital safety net a company can have during a period of corporate transition.
Because it's actual money they can use.
Yes. Free cash flow is the money left over after a company pays for all its operating expenses and capital expenditures. It means they aren't going to struggle to fund new content or pay down debt or keep the lights on while they figure out life after Reed Hastings.
Yeah, that's a huge cushion.
They are generating billions in actual physical cash, not just accounting paper profits.
And what about their debt? Because when interest rates fluctuate, highly indebted companies usually get crushed. I'm looking at their balance sheet summary here, and their assets vastly outweigh what they owe.
Yeah, they are sitting on total assets of $55.6 billion versus total liabilities of $28.98 billion.
It's almost double.
Right. They have nearly twice as many assets as liabilities. Furthermore, their liquidity is incredibly strong. They have an interest coverage ratio of 19.79, and their debt-to-equity ratio is just 0.46.
Okay, let me put that interest coverage ratio into perspective for everyone listening. An interest coverage ratio of 19.79 essentially means that for every single dollar of interest Netflix owes on its debt, they have almost $20 in actual earnings to cover it.
Which is insane.
It is. They could pay their interest obligations 20 times over without breaking a sweat. They are clearly not over-leveraged.
Which is incredibly rare in the streaming wars right now. I mean, most of their competitors are bleeding billions trying to build out their platforms. Netflix has built a fortress balance sheet. So we are looking at this incredible core tension, right? A fundamentally sound cash printing machine that the trading floor is suddenly treating like it's highly toxic.
So if the balance sheet is a fortress, why is the actual trading floor treating them like they're toxic? Let's look at the price action to see who is actually hitting the sell button.
Oh, this is the interesting part.
Because here is where the story gets really bizarre. Insiders at Netflix executives and board members sold off $141.1 million in shares in the 3 months prior to this earnings report.
Right, before the bad news.
Yeah. But then, after the 9.72% drop, high-profile funds like ARK Invest stepped in and bought the dip, scooping up over 26,000 shares. So here's where it gets really interesting. Are retail traders getting played here? Insiders dump at the top, and institutions just swoop in to buy the dip.
Well, we have to analyze the timelines and motivations of these different players. Insiders might sell for a dozen mundane reasons.
Yeah.
Tax obligations, diversifying their personal portfolios, or scheduled selling plans.
Right. The 10b5-1 plans.
Exactly. But it is entirely possible they saw the internal projections for that weak Q2 guidance and decided to take some risk off the table before the market found out.
Which is super convenient for them.
Oh, very. But on the flip side, a fund like ARK Invest operates with a very specific long-term thesis focused on disruptive innovation. When they see a near 10% haircut on a company they fundamentally believe in for the next 5 to 10 years, they just see a discount.
So they're not worried about next week.
No, not at all. They aren't trying to day trade the post-earnings gap. They are accumulating shares for 2030.
That makes sense for a fund with billions to spare. But if you are a retail trader looking at the short term, the trend is undeniable. The technical analysis shows a brutal short-term downtrend following that post-earnings gap down. What are the algorithms actually looking at here?
The algorithms are heavily focused on momentum indicators, and right now they are flashing dark red. Let's start with the RSI, the 14-day Relative Strength Index. It is currently sitting between 25.27 and 26.96.
Okay, so for those who might be new to reading charts, the RSI is a momentum scale from 0 to 100. Anything under 30 is generally considered deeply oversold. Think of it like stretching a rubber band. The further you pull it down past 30, the more tension builds up and the more it naturally wants to snap back up.
That is a great visual. But we have to factor in the MACD as well, the moving average convergence divergence.
Okay, what's that showing?
Well, the MCD looks at the relationship between two different moving averages of a stock's price. Right now, it is sitting at negative 2.0, which is a strong bearish signal.
Negative 2.0, got it.
Yeah, it tells us the short-term momentum is accelerating downward faster than the long-term trend. However, I want to caution anyone looking at that stretched rubber band on the RSI.
Why is that?
Because oversold does not guarantee an instant automatic bounce. If a stock gaps down on high volume because the fundamental narrative of the company has changed, that rubber band might just be rotting.
Oh, that's a scary thought.
It is. The stock can stay technically oversold for weeks while the market slowly digests the new reality.
Which brings up the question of where the bleeding actually stops. Support and resistance levels are basically the floors and ceilings of a stock's price. I see the 50-day moving average is all the way up at $103.39.
Right, way above the current price.
Yeah, since the current price is down around $97, that $103 level, which used to be a floor, has now become a ceiling it has to break through. There is also the post-earnings gap ceiling at $103.11. But where is the floor right now?
The stock is currently testing a critical floor at the 200-day moving average, which sits at $97.06.
That's close.
Very close. That moving average is a major psychological battleground for long-term investors. If the price breaks firmly below that 200-day line, things get precarious.
And if it falls below that?
The immediate support levels below that are $96.04, which aligns with the key 0.500 Fibonacci retracement level, and then further down at $91.06.
Okay, let's explain that Fibonacci level really quickly. A 0.500 retracement means the stock has basically given back exactly 50%, or half, of its recent historical climb.
Exactly.
Algorithms and human traders alike watch this exact halfway line as a psychological floor. They use it to decide if the stock is just resting during a broader climb or if the rally is completely dead.
And the battle happening right now at that $97 level is a tug-of-war between the panic sellers trying to exit at any cost and the value buyers stepping in hoping that 50% retracement holds.
So we have Wall Street analysts looking at the exact same numbers, the exact same charts, and they are completely divided.
Oh, it's a massive split.
It really is. I am looking at the analyst ratings, and the consensus is somehow still a buy or moderate buy based on a pool of 45 to 75 analysts. But the price targets they are issuing are wildly far apart.
Yeah, the spread is crazy.
The lowest target on Wall Street is $80. The median target is $114.46. And the highest target is $151.40.
Yeah.
So what does this all mean for you, the listener? How can Wall Street look at the exact same balance sheet and be this divided? I mean, that is a massive $70 spread between the high and low price targets for a mega cap company.
You are seeing a fundamental philosophical debate about what kind of company Netflix is transitioning into. Let's contrast two very specific claims here. Morningstar says the stock is overvalued. They give it a fair value estimate of just $80.
Okay, why so low?
They are focused heavily on the downside risks. They see high market volatility. They are warning about the very real phenomenon of subscription fatigue among consumers.
Which is definitely a thing.
Oh, absolutely.
Right.
And they're pointing to a slowing content output. Netflix only released 23 original titles in Q1. That is a dramatic slowdown from the days when they were greenlighting everything under the sun to build their library.
Right.
Morningstar looks at that and sees a growth story that is ending.
But then you have Guggenheim on the other side of the ring, claiming the stock is actually undervalued, setting a target of $120 to $130.
Right.
They're likely looking at the PE ratio, the price-to-earnings ratio. It's sitting at 31.44 trailing 12 months. For a lot of standard companies, paying 31 times earnings is expensive. But for Netflix,
It's actually cheap for them.
yeah, that is remarkably low relative to its historical 5-year average. During their peak growth years, they used to trade at PE multiples of 60, 80, or even well over 100.
And if we connect this to the bigger picture, this brings up the most dangerous concept for retail investors: the value trap.
Oh, I hate value traps.
They are brutal. A value trap happens when a stock looks incredibly cheap because its multiples, like that PE ratio, have compressed compared to historical norms, or because the sheer share price has fallen significantly. Retail traders pull up the chart, see that 52-week high of $134, see the current price of $97, and assume it simply has to go back up because it's on sale.
But a value trap isn't a temporary sale. It's like buying a top-tier DVD player on massive discount in the year 2010.
Yes.
Yes, the price relative to its history is incredibly cheap, but it's cheap because the underlying technology is becoming obsolete, not because the market made a temporary mistake.
That analogy perfectly captures the risk. If you mistake a structural markdown for a temporary discount, you get trapped.
Right, catching a falling knife.
Exactly. If the broader market fundamentally believes Netflix's hyper-growth days of adding millions of new subscribers every quarter are permanently over, then a PE of 31 isn't cheap at all.
It's just the new normal.
Yeah, it might actually be perfectly fair or even slightly expensive for a mature, slow-growing media company. Retail traders buy the dip based on the glory of the past, while the institutions are pricing the stock based on a newly lowered realistic future.
So let's map out the two paths forward based on all this data. What is the bear case versus the bull case from here? Let's start with the worst case scenario. If the value trap theory is right, where does this go?
Well, the bear case, the continuation lower, hinges on the idea that the short-term outlook remains highly uncertain. The market still needs months to fully digest Reed Hastings' exit.
That leadership vacuum is tough.
It creates immense strategic uncertainty. Combine that with the cautious profit guidance for next quarter and a lack of major cultural phenomenon content catalysts driving new signups.
Yeah.
If subscription fatigue is real and households are aggressively canceling services to save money in a tight economy, the stock could easily crash through that 200-day moving average, test the $91 support level, and drift steadily downward toward Morningstar's $80 target.
Okay, so that's the bear case. What about the best case scenario? The bull case. Because there is a very strong argument for recovery here. We already established the massive $5 billion in free cash flow and the fact that top-line revenue is still growing at double digits.
Absolutely.
But the real driver of the bull case seems to be their pivot into advertising. I am seeing medium to long-term projections suggesting their ad revenue alone could hit $3 billion by 2026.
The advertising tier is the entire crux of the bullish thesis. Value investors are looking beyond the standard PE ratio and focusing on the PEG ratio, the price-to-earnings growth ratio.
Okay.
They're finding the stock attractive because that ad revenue introduces a completely new high-margin growth engine.
You know, this shift to an ad tier feels like a completely different business model than the old subscriber-only Netflix we all grew up with.
It's a total paradigm shift.
Yeah. For years, the only metric Wall Street cared about was user acquisition. The singular question at every earnings call was, how many net new subscribers did you add? Now, it feels like they are transitioning into a traditional media network. They are monetizing eyeballs with commercials. They don't necessarily need millions of brand new users if they can squeeze significantly more ad revenue out of the users they already have.
And that transition is precisely what the market is struggling to price in right now. The short-term chart looks incredibly bleak because the old metrics, relentless subscriber growth and aggressive quarterly EPS beats, are softening.
Yeah, those old numbers are fading.
But the long-term potential is tied entirely to them successfully pivoting into a highly profitable ad-supported media giant. Value investors aren't losing sleep over next month's moving averages.
No, they're looking way past that.
They are eyeing that $3 billion ad revenue target. They see a company throwing off $5 billion in physical cash in a single quarter and recognize the foundation of a media cash cow.
So let's wrap this up and summarize the core tension we've uncovered today. On one hand, you have a fundamentally profitable, incredibly liquid company with a fortress balance sheet and massive cash flow generation. On the other hand, they are facing a monumental transition phase. A visionary founder leaving, cautious forward guidance, and a complete shift toward an ad-based business model. And the result of that tension is a completely fractured, highly volatile stock chart where the market wiped out nearly 10% of the company's value in a single day.
It is the classic market battle between short-term uncertainty and long-term fundamentals.
It always is.
Right. The stock market violently rejects uncertainty, and right now, Netflix's transition has provided plenty of it. But underneath all that charting noise and algorithmic panic is an undeniable proven engine of cash generation.
Which leaves us with a final provocative thought for you to mull over. If Netflix is truly transitioning from a high-growth tech stock into a traditional media cash cow with a multi-billion-dollar ad business, are we all looking at the chart and valuing it using the completely wrong metrics entirely?
It's a great question.
If the rules of the game have fundamentally changed, maybe the scorecard we use to judge them needs to change too. We want to hear your take on that cliffhanger question. Drop your thoughts in the YouTube comments below. And before you go, remember to like this video and subscribe to the channel so you never miss a deep dive. Just a final reminder, everything we discussed today is for educational exploration and is not financial advice. Keep learning, keep questioning, and we will see you on the next deep dive.